Hello everyone, Kemp with Zuna. Something, some things are very easy and quite common sense in trading. And for example, the use of volume and just traditional support and resistance levels based on prior highs, prior lows, etc. And a lot of times, what I see is traders get a short signal, for example, or a long signal, for example, and they just sit there and stick through it no matter how many times the market gives them signals that there is a problem with their trades, and they'll sit through it. And one of the simplest things to do is combine volume and price action. Volume and the reason I always use candlesticks is because visually they translate so much more information than a bar chart, than a regular open, high, low, close bar chart. With a candlestick, you can easily see this candle right here, for example. The open and the close is pretty much the high and the lows of the candle. Another issue is that I see people using uh, bar charts with just the close on it, high, low, close. And if you've been trading for many years using that, that's fine. There's no issues with that because you're so used to that by now. But for anybody who just ignores where the market open on any interval where the open was, it's just you're leaving out so much information. It's important where it opens and where it closes on any candles on any interval, regardless. Now, when you see, I have the paint bars here that reflect the volume information based on this histogram, and I just want to show some common sense stuff. I mean, this is simple stuff, and it doesn't have to be that complicated. Here, high volume came in, and you can see the result of that high volume was that we created this. In other words, the bar opened here, tried to close up here, it couldn't. Sellers came in, pushed it down, and you have this long shadow, and then another long shadow, and the market pulls back a little bit, and then eventually it comes back up, and then we get this candle. Now, if you just look at this candle in isolation with the high volume, okay, so you say it's a candle with high volume. The important thing is to understand what that high volume did. In other words, why did that high volume come in here and not, for example, in these bars here? So essentially, this candle broke above this resistance level. Okay, so now that resistance level becomes support level. Now, what has price been doing all day long? It's been moving up. Okay, we opened up, we tried to push down, and then we started going up. Relative volume ratio is telling us that this is a serious rally because there's extreme, the volume is very high on it. Okay, so we can say that this is a decent rally going on so far, and at some point it'll end. Now, if you considered all that information, let's say you shorted here for whatever reason. The market gave you one chance to exit here, another chance to exit here, another chance to exit here. In other words, it gave you three opportunities to tell you that your short is not able to break below this resistance level. Okay. It also told you information that you should possibly consider going the other way because we broke the most recent resistance level on high volume, and now obviously the thing to do is to buy a pullback here, anticipating price to go higher. So you had several opportunities to get out of a short trade and get into a long trade. And if you add even further more context to the trade, okay, what happened yesterday? We opened up, we tried to rally, we couldn't, the market had no breath, we fell, we sold off. Put in a high, we open up here, put in a low, we come up to test yesterday's high, and we broke above it. Now notice where that volume came out, that high volume bar, okay, it's also a break above these highs here, okay. So what essentially happened is we broke out. So that was a pullback, buying a pullback of a breakout with a target to fill this gap and possibly retrace back up to these highs, but at the minimum to fill that gap. So simple stuff like that. It's just a matter of having the faith in yourself to believe in this volume price action, and just some common sense, and use the market internals, etc., to help you as well. Combining that stuff and having the confidence to stick to a method like that and do some back testing to make sure that you understand what's going on. The key with volume and price action is to look at it and understand it. So when you see high volume come in, try to figure out why did the high volume come in there. Then look at your most recent support resistance levels. Look at context. Try to look back at some of a day or two ago where we are with respect to the price action of a day or two ago, etc. So it's just as simple as that. Just now, do we get clear setups like this every day? Not every single day, but when you keep up with this, when you practice using volume with your price action, you almost always find a couple of setups each day. Here's another one right here. Okay, we have this resistance level here. Okay, we break out of it on high volume, we go above it, we come back, we don't quite touch it on, we don't quite pull back to it, then we move back up again. Again here, we break above. If you look at these high volumes, you'll notice that a lot of them coincide with breaking above a certain level. Okay, we have this high volume, we go above, we pull back to it, and price just stops there again. So you can continuously, and this is why it's so important to have the volume on your price action, because when you see it down here, it's great to also have it down here because you want to see the low volume stuff too. But when you have it on your price charts, then you begin to see how that volume interacts with price and how price respects, or well, respect is not a good word, but how price um, relates to that volume. The relationship between what price does with high volume intervals is quite important, and probably one of the first fundamental things that any trader should begin studying prior to adding all kinds of other indicators to their charts.